Hey everyone, welcome back to Corporate Decoder, the place where we help you navigate the tricky world of corporate filings. And today we are decoding Fang Holdings Limited, or as you might know them from their stock symbol, SUNY, their latest annual report. It seems their future has been a bit of a bumpy ride, and we are going to dive deep into the numbers and the risks to see what is really going on. Make sure you are subscribed to Corporate Decoder because we are pulling back the curtain on these filings to bring you clear, easy to understand insights. And if you want to join a community of fellow corporate finance enthusiasts, check out our Discord link in the description below. Alright, so what exactly is this document? Well, it is called a Form 20 FAN, annual report that publicly traded companies in the US have to file with the Securities and Exchange Commission, or the SEC, to give investors a comprehensive look at their business and financial performance over the past year. Think of it as their yearly checkup. And Fang Holdings is filing this one for the fiscal year ended the 31st of December 2024. Now, this report is a massive document covering everything from their history and business operations to their financial results and the risks they face. But like any good decoder, we are going to cut through the noise and focus on what actually matters. Let's start with the really important stuff, the key information section. This is where they lay out some crucial details about their structure and how they operate. Now, Fang Holdings is a bit unique because they are a Cayman Islands holding company and they primarily conduct their business in China through what are called variable interest entities, or VIS. This is a common setup for Chinese companies that want to operate in industries where foreign investment is restricted, like the internet sector. Instead of directly owning these operating companies, they use special contracts to control them and get all the profits indirectly. The report states that these variable interest entities accounted for a significant chunk of their total revenues. In 2024, though, revenues contributed by these entities were 49.6% of the total, which is a noticeable drop from 66.8% in 2023. This shift could mean they are relying more on their directly owned subsidiaries, or that the VIS are performing less relatively. Operating in China means dealing with a lot of regulations, and Fang Holdings makes it clear they need specific licenses and approvals to run their businesses. They mention they have the necessary licenses like the ICP license required for internet services and approvals for operating electronic bulletin board services. They also have licenses for Internet Audio-Video Program Services and Mobile Internet Audio-Visual Program Services. However, they also acknowledge the constant uncertainty around interpreting and applying these laws and regulations, which could mean their current licenses might be deemed insufficient, leading to potential fines or other actions. Now, this is a big one for many foreign companies that trade in the US. It is called the Holding Foreign Companies Accountable Act, or the HFCAA. This law could lead to foreign companies being delisted from US stock exchanges if US regulators like the CC cannot inspect their audit reports for a certain number of consecutive years. Fang Holdings mentions their auditor GGF-CPA Limited is registered with the PCAU, the Public Company Accounting Oversight Board. But because their audit work papers are in China, there is always a question about whether inspections can be fully completed. They are not sure if their auditor will always be subject to full PCAOB inspection, and this uncertainty could impact their ability to stay listed in the US, which is a real risk for investors. Alright, let's get to the heart of the matter, the financials. This is where we see the true pulse of the company. Looking at the selected consolidated financial data, we can see a stark trend. Total revenues have been dropping. In 2022, they were $80.5 million, then down to $50 million in 2023, and further down to $30.7 million in 2024. That is a massive decrease, nearly two-thirds of their revenue has vanished in just 2 years. Marketing services, which used to be their biggest revenue driver, saw a huge drop. It was $37.2 million in 2022, down to just $11 million in 2024. The company explains this is due to the continued and deepening downturn across the broader PRC real estate industry. Developers are cutting back on advertising budgets because of soft housing demand, financial pressure on developers, and a cautious regulatory environment. Losing that much revenue from their core business is a significant challenge. And when revenue shrinks, so do profits. In fact, they are not making profits, they are making losses. The net loss was $75.6 million in 2022, widened to $179.7 million in 2023, and then improved significantly to $28.8 million in 2024. While the loss in 2024 is much smaller than in 2023, it is still a loss, and the reason for improvement was a big one, a massive impairment charge for long-lived assets. We will get to that in a moment, but the fact is they are still losing money. This is a big number that explains some of the financial picture. In 2023, they had an impairment charge of assets of $151.1 million. What is impairment? Well, it is basically an accounting adjustment to write down the value of an asset when its book value is higher than what it is currently worth, or what it is currently worth, or what it is expected to generate in the future. They explained this charge was related to certain buildings and land use rights because of the significant downturn in China's real estate market. The market got even worse in 2024, and they wrote down the value of these assets by another $55.1 million. This means their property assets have lost significant value on paper. No impairment charge was recorded in 2022. On the flip side, they had a positive number here in 2024, a reversal of credit loss provision of $41.3 million. They explain this means they recovered some old receivables that they had previously written off. This is good news for cash flow, but it also might reflect a challenging environment in prior years where they had to set aside a lot for potential losses. Looking at their operating expenses, we see a trend of cost cutting. Selling expenses decreased significantly in both 2023 and 2024. In 2024, they were down 23.1% compared to 2023. This is because they reduced staff costs, distribution expenses, and promotional spending. This is a clear sign they are focusing on efficiency and cutting costs in response to lower business volume. General and administrative expenses, or GA expenses, also decreased in 2024 by 30.5% compared to 2023. This also shows their commitment to cost control. However, in 2023, these expenses actually increased by 89.8%, mainly due to some one-time costs and legal expenses. Now let's talk about earnings per S-Hair. They had a basic and diluted loss per S-Hair of $0.84 in 2022, a much larger loss of $1.99 in 2023, and a smaller loss of $0.32 in 2024. This shows the massive swing in losses in 2023 and then a recovery in 2024, though they are still losing money on each share. Their total assets have also been decreasing. In 2023, total assets were $947 million, and by the 31st of December 2024, they were down to $838.8 million. This is largely due to the decreasing value of their property and equipment and a significant decrease in short-term investments and cash. Shareholders' equity has also taken a hit. From over $383 million at the end of 2023, it decreased to about $346.9 million by the end of 2024. This is mostly due to the net losses they incurred. Now let's touch on the risks. The company heavily relies on contractual arrangements with these variable interest entities. They admit these contracts might not be as effective as direct ownership for control, and they could face severe penalties or be forced to restructure if the Chinese government decides these contracts don't comply with laws. There is also uncertainty about future PRC laws that could affect their entire structure. This vice structure is a constant source of risk for Chinese companies and their investors. Remember the ticker SFUNY well, their ADSs were delisted from the New York Stock Exchange in May 2022. This means they are now trading on the OTC market, which is much less liquid and can have a negative impact on the stock price and their ability to raise capital. The report states this delisting has already had a material adverse effect by limiting liquidity, depressing the stock price, and making it harder to attract institutional investors. This is an interesting twist. In September 2023, their former chairman, Mr. Richard Jiangong Dai, proposed a going private transaction to buy all the outstanding shares at a certain price. The board has formed a special committee to look into this proposal, but as of the report date, no decisions have been made. The market price of their ADSs has been affected by this proposal, and there is no guarantee it will go through. Another significant legal matter is a winding up petition filed against Fang Holdings Limited in the Cayman Islands by certain shareholders in January 2024. They allege unfair prejudice and oppression by management through Related party transactions, failure to comply with disclosure requirements, and managing affairs in a way that disregards minority shareholders. The company is contesting this petition and its outcome is uncertain. Adding to the legal entanglements, there is a property management contract dispute. A Beijing court ordered 8 defendants, including Fang Holdings subsidiary, to pay about $5.7 million plus penalties relating to unpaid property management, heating, and cooling fees. The company is appealing this judgment. So what is the verdict on Fang Holdings? Well, the financials paint a picture of a company facing significant headwinds. Revenues are shrinking drastically due to the struggling real estate market in China. They are losing money and have had to write down the value of their assets by a massive amount, reflecting the tough market conditions. Their move from the NICE to the OTC market is a major red flag for liquidity and investor access. On top of that, they have serious structural risks with their VI setup, ongoing legal challenges, including a winding up petition and a property management dispute and a proposed takeover that might or might not happen. The company is trying to manage costs and streamline operations, which is a sensible move, but the core issue remains the deep and prolonged real estate downturn in China. While they showed a much smaller net loss in 2024 compared to 2023, this was largely driven by the asset right. Downs and a recovery in some receivables, not necessarily by a rebound in core business operations. The fact that they are still unable to generate profits from their main business lines is concerning. The future direction seems uncertain with the proposed going private transaction and the ongoing legal battles. Their strategy of cost-cutting and focusing on core services might help them tread water, but a significant turnaround would likely require a substantial improvement in the overall Chinese real estate market or a successful pivot into new profitable ventures. What is your take on Fang Holdings' current situation and the potential impact of that going? Prove it proposal, let us know your thoughts in the comments below. If you found this analysis helpful, please give this video a thumbs up and subscribe to Corporate Decoder for more deep dives into the world of finance. And don't forget to join our Discord community linked in the description for more exclusive content and discussions. Thanks for watching, and we will see you in the next one.